Hi, I'm David Gawant from Pure Portfolios, and I'm here today to talk to you about real estate investment trusts, REITs. A couple days ago, our investment and marketing team here asked me if I'd do a quick video on REITs. And I thought to myself, sure, I know what REITs are and can present on that. And I started to think, what exactly are REITs and how do they work? And I started asking myself all these different questions and had to do quite a bit of research. And they're pretty straightforward in general. REITs obviously provide to us, from an investment standpoint, diversification benefits in a portfolio and some income as well. But I'll just try to cover the basics, and we'll leave it up to you to follow up with any questions if you have any. So what are REITs? Well, they're private or public companies. They own or finance income producing real estate across various sectors. Think healthcare, residential, hospitals, hotels, data centers, infrastructure. They're also specialized REITs as well. And those would be more so like movie theaters or casinos or farmland, even outdoor advertising sites. At least 75% of the assets have to be in real estate, with 75% of the gross income coming from rental income. And REITs have to pay out at least 90% of their taxable income to shareholders, and those are in the form of taxable dividends. So, REITs are best for tax-advantaged accounts like IRAs. In terms of how do they work? Well, investors provide capital, the manager goes out and buys properties and manages a portfolio, let's say disposing of poorly performing properties and investing in new properties with a higher expected return. They lease the space, they collect rent, and then they basically generate income, which is paid out to shareholders. And again, keep in mind that the dividends are taxable, and those tax rates kind of depend on how they allocate the income in terms of if it's ordinary income, which is usually the bulk of the dividends that you'd receive, or if it's cap gains or even a return of capital. Why invest in REITs? While there's a diversification benefit, they have a fairly low correlation to other asset classes and can help reduce portfolio risk and have long-term capital appreciation potential. So they can help to increase returns. They are transparent. They're fairly liquid versus, you think about owning private real estate. And, they give investors an access, let's say, to a diversified pool of real estate investments. So there's a convenience factor. You don't have to go out and buy, finance, manage, maintain properties. So they provide stable and predictable cash flow in the form of dividends, again, with the potential for long-term capital appreciation. And returns have been pretty decent. About a 7% annualized return over the last 10 years. The last 3 years have been relatively flat. And then this year, REIT performance has not been great, down about 15+%. And some of those returns are impacted by operating costs and expenses of the company that run the trust. In terms of the case for REITs today, from an investment standpoint, currently, property values are strong, supported by the cyclical recovery from the pandemic. You can think about REITs are typically able to raise rents during periods of rising interest rates and inflation. So, I'd say you can make a pretty strong case for REITs in a portfolio today in this current investment environment. Valuations appear to be relatively attractive with the recent market volatility, and then also discounted to the net asset value of the holdings in the REITs by about 10%. And anytime you get a greater than 10% discount to net asset value, the returns for the following years are pretty attractive. What do we own at Pure? We typically own the Schwab Real Estate Investment Trust, SCHH. It has about a 2.2% yield, and then it tracks the Dow Jones Equity REIT Index, has about 140 holdings across various sectors that I mentioned before, with about $6 billion in assets. It's the largest publicly traded REIT ETF, and it also excludes mortgage REITs as well, which provides a little bit more stability to the REIT. And 99% of it's invested in U.S. properties, about 1% in Canadian properties. You've probably seen some of the other publicly traded equity REITs like American Tower, Prologis, Crown Castle, digital infrastructure types of REITs like Equinix, and also, Weyerhaeuser has its own REIT as well for Timberland. Some are invested in malls and senior housing facilities like Welltower or Simon Property Group. So there are a variety of different REITs and ways to invest in REITs. The Schwab ETF actually owns all those, large REITs in its portfolio. So we feel like that's the best way to get the diversification and the liquidity as well, with the low cost of owning ETF. As far as the industry goes, the U.S. REITs have an equity market cap of about 1.4 trillion and own about 4 trillion in gross real estate assets. Most of that's from publicly held REITs, about 2.5 trillion of that. And that encompasses about 500,000 properties across the US. So, there is some type of benefit to society here in terms of the REITs help communities grow and revitalize, and they contribute to the tax base and the job market. The whole concept about REITs was, I think it started in the early 60s when Congress wanted to give all individuals the opportunity to invest in income-producing real estate, not just the wealthiest investors buying private real estate. And today, that industry's flourished. There are more than 225 REITs in the U.S. registered with the SEC and that trade on major stock exchanges, and about 30 REIT ETFs. It's about 3% of the S&P. So overall, we think REITs are a great way to provide additional diversification in portfolios with some income potential and, stable income in the form of dividends, and some long-term capital appreciation potential as well. So hope you enjoyed the video. If you have any questions on REITs, please don't hesitate to reach out to your advisor at Pure Portfolios, and I hope you have a great day.